Hi there, and thank you for joining us here at PhillipCapital's Market Watch. I'm Sze Han, Senior Dealer from PhillipCapital Contracts for Differences, CFD. In this episode, we'll be going through the major themes that could affect the stock markets in 2022 and how you can position your portfolio for the coming months. Last year, the US stock markets did remarkably well, and the strength and extent of the stock market rally surprised even the most bullish of analyst forecasts that were made at the start of the year. For the 12 months ended 31st December 2021, the Dow Jones Industrial Average rose 18.73%, while the Nasdaq Composite surged 22.14%. The S&P 500 is the best performing of the trio, recording a blistering gain of 26.89% to cap the year. Taking a closer look into sector performances in 2021, we see that all 11 sectors of the S&P 500 registered double-digit gains. The best returns came from the energy sector following a recovery in global crude oil demand, and the real estate sector, which was boosted by a heated US property market earlier in the year. Even the worst performing sector, the utilities sector, captured nearly 14% gain for the year. Looking forward to 2022, however, many analysts are of the view that this year, the US stock market will continue to trade up. However, the path upwards will be more bumpy, and the overall gains of the US stock market this year will not be as good as last year's. The main impediment to the US stock market performance this year is the Federal Reserve, which has turned increasingly hawkish. In a statement last month, the US Central Bank signaled that the quantitative easing program launched 2 years ago to help businesses and individuals cope with the economic fallouts of the COVID pandemic will end in March this year. The Fed policymakers are also projecting 3 interest rate hikes, each in 2022 and 2023, and 2 more in 2024. COVID-related disruptions such as supply chain blockages, inflation brought about by surges in oil, raw materials, and commodity prices, as well as wage inflation caused by low labor participation and labor tightness, will also be factors that will be closely watched, as these may cause the Fed to either slow down or speed up on their scheduled interest rate hikes. As we transition into the next phase of the economic cycle, it is increasingly more important that we go up the quality ladder in our stock selection. We will avoid smaller companies with high debt and weak or negative cash flows, as these businesses will be a greater challenge when interest rates are higher. Instead, we will recommend established big cap companies that have low to no debt, healthy cash flow, strong balance sheet, and good track record of profits. One group to consider are the mega cap tech stocks such as Meta, Microsoft, Apple, Amazon, and Alphabet. These companies have displayed resilience in previous sell-offs and are more likely to ride out the challenges of a higher interest rate environment ahead. Traditionally, a higher interest rate environment is favorable for banks, so stocks of strong and established lenders such as JP Morgan, Citibank, and Bank of America can be included in our investment watch. The XLF ETF can also be considered for broad-based positioning into the sector. A third group that may continue to do well in 2022 will be payment services companies such as Visa and MasterCard, as consumer spendings remain high. A fourth group that can weather higher interest rate will be the electric vehicle companies, as this is a sector with multi-year growth trajectory. Again, we will recommend to go for quality frontrunners within the sector such as Ford, GM, or Tesla. Besides US, investors are also increasingly looking towards the European Union and China for outperformance in 2022, as these markets currently offer cheaper valuations. In the EU, the pace of recovery had been slower, and dovish central banks and continued pan-European fiscal stimulus could continue to provide support and growth to the stocks in the region. In China, the series of clampdowns by authorities had depressed stock valuations, and the government's determination to uphold its zero-COVID policy had curtailed Chinese stock performance last year. However, as more and more companies comply with the regulators' requirement as vaccination rates increase, pro-growth policies could return. Also, further easing by the People's Bank of China expected in the coming months could help foster an environment for stock market rebound. And that's all for PhillipCapital's Market Watch. Do remember to like and follow us on social media and subscribe to us on YouTube. Also, tell us what you think. How well will US stock market perform this year, and will 2022 be the year that outperformance rotate to European and Chinese stocks? Leave your comments. Thanks for joining us, and we'll see you soon.